Recently, shares of Bombay Stock Exchange, India's oldest stock exchange, saw a sharp drop of nearly 8%. Over the last 5 days, the stock is down by 21.5%. This happened after its competitor, the National Stock Exchange, made a significant change to its delivery expiry schedule. Not just this, there are other reasons for the stock to see such a decline too. Stick till the end to understand why. Firstly, what is BSE? The BSE, established in 1875, is the oldest stock exchange in Asia and one of the largest in the world. It's based in Mumbai, India, and provides a platform for trading various financial instruments like stocks, derivatives, and currencies. The BSE Sensex, which tracks the performance of 30 large companies listed on the exchange, is a key indicator of India's stock market health. The BSE has a significant impact on India's economy. It's not just about stocks. The exchange also deals with other financial products like mutual funds and investment banking services. The BSE is known for its solid infrastructure, high level of transparency, and efficient trading mechanisms. The BSE generates most of its revenue from transaction fees, meaning it earns a portion of every trade made on its platform. It also earns from services to corporates, clearing and settlement funds, and other sources. Alright, so here's the situation. National Stock Exchange has made a significant change to its derivatives expiry schedule. Starting April 4th, all weekly Nifty index futures and options contracts will expire on Monday instead of Tuesday. This means that from now on, all Nifty futures and options will have their expiry on the last Monday of the expiry month instead of the usual Thursday. Now, why did NSE make this change? According to a spokesperson from the NSE, the reasoning behind this decision isn't really about gaining any advantages, but more about efficiency. They pointed out that a lot of geopolitical developments tend to happen over the weekend. So shifting the expiry to Monday will help traders manage these changes better. Now, the Bombay Stock Exchange also deals with derivatives like the NSE. However, the BSE has a different expiry schedule. The BSE's weekly derivatives contract currently expires on Tuesday and not Monday, and their monthly contracts expire on the last Tuesday of the month. For instance, BSE has 3 main derivative contracts, one for the Sensex, BankX, and Sensex 50. But only the Sensex contract has a weekly expiry on Tuesday. So the big change in expiry days by the NSE could impact the trading volumes on BSE in a few ways. Since the NSE is aligning its expiry days to Monday, which is already a popular trading day, this could make the competition even tougher for BSE. More traders might move their businesses to NSE, and that could result in a shift in market share, leaving BSE with a smaller slice of the pie. This could lead to a fewer traders using BSE for the derivatives trades, which means lower trading volume for BSE. BSE makes a large portion of its revenue from derivatives. In fact, around 41% of BSE's total income comes from the equity derivatives. So if fewer traders are using BSE for their derivatives contracts, the exchange will generate less income from this segment. That's a big deal for BSE because derivatives are a major source of revenue for them. Another reason for the drop in BSE stock price is a new consultation paper that came out this week from SEBI. Now, let me explain this a bit more. Earlier this month, Goldman Sachs, a well-known international brokerage, lowered its target price for BSE shares. They cut it from 5,650 rupees to 4,880 rupees, but they kept a neutral rating on the stock. Now, why did they do this? Well, it's because SEBI's proposed changes in how they monitor market risks might reduce activity from proprietary traders. These traders who use their own money to trade make up a big chunk of trading volume on BSE. Now, what exactly is SEBI proposing? On February 24th, SEBI issued a consultation paper suggesting a shift in how open interest in equity derivatives is calculated. Currently, it's calculated using something called notional terms, but SEBI wants to move to a new method called future equivalent or delta-based calculation. Now, by switching to a future equivalent or delta-based calculation for open interest, the risk management of derivatives will become more tightly aligned with what's happening in the actual stock market. SEBI believes that this change will make the market less susceptible to manipulation, but it could also make trading in these derivatives a bit more complicated and less attractive for proprietary traders. Why? Because these traders thrive on the ability to take large portions quickly and move in and out of trades. If the new method of calculating open interest results in stricter rules or more capital requirements, proprietary traders might find it harder to engage in the same level of high volume trading. Now, Goldman Sachs believes that these proposed changes could affect BSE's trading volume, especially since nearly 70% of BSE's daily turnover comes from proprietary traders. However, Goldman Sachs also mentioned that the final outcome of these proposed changes is uncertain, and the consultation paper was something that the market did not expect. On top of all this, BSE is also dealing with some legal troubles. A Mumbai court recently ordered a FIR to be filed against former SEBI chief Madhavi Book and two BSE officials over an old case from 1994. Now, this case involves some irregularities in how a company was listed on BSE. This legal situation adds even more pressure on BSE. No one likes uncertainty, especially when it involves legal problems. Here are some key takeaways. BSE stock has taken a pretty big hit recently, and there are a few reasons behind this drop. The biggest factor is the change made by the National Stock Exchange in its expiry schedule. Another reason for the decline is SEBI's proposed changes on how it monitors market risks. And BSE is also dealing with some legal issues. Now, here is what an investor needs to keep an eye on. The fact that NSE shifted its expiry date to Monday could make it more attractive for traders, which could hurt BSE's market share. Investors should keep an eye on any changes in BSE's trading volumes to see if it can stay competitive. The changes SEBI is proposing for calculating open interest could impact proprietary traders, which could further affect BSE's trading volumes. It's important to track how SEBI's final decision unfolds, as it could shift investor sentiment. The ongoing legal issues at BSE are something investors need to keep an eye on. Any bad news coming from these investigations could cause more uncertainty and shake investor confidence. Now, let's look at some important market updates. US President Trump has announced that starting April 2, the US will impose reciprocal tariffs on a range of imports from countries with what he considers unfair trade policies. This includes major trading partners like India, China, Canada, and European Union. Now, what exactly does he mean by reciprocal tariffs? Essentially, Trump is saying that if other countries impose high tariffs on American goods, the US will do the same to their products. Now, he's been pushing for this idea for a while now, claiming that countries have been benefiting from lower US tariffs while placing higher duties on US goods, which creates an unfair trade imbalance. In his statements, Trump specifically highlighted India as a major example, pointing out that India imposes tariffs that can be over 100% on some American products. His message is clear: whatever countries charge the US will respond by imposing similar tariffs on their goods. This move is a part of Trump's broader push to rework US trade policies. Next up, we have Tata Motors. Tata Motors electric vehicle sales fell by 23% in February 2025, with a 12% year-on-year decline for FY25. The decline is primarily attributed to the withdrawal of government incentives under the FAME2 scheme and rising competition from the companies like JSW Motor. This has led to a decrease in Tata's market share from 62% in 2024 to 46% in December. Coforge's share price surged by over 10% today following the company's announcement of board approvals for a stock split and two acquisitions. On March 4, 2025, the company approved 1:5 stock split, reducing the face value from ₹10 to ₹2 to boost liquidity and attract small investors. The record date will be announced later. Additionally, Coforge announced the acquisition of Rhythmos Inc. for $30 million with performance-based payouts and a 100% stake in TM Labs for AUD 20 million. Both transactions expected to close by March 31, 2025. Angel One confirmed unauthorized access to client data on February 27th, linked to compromised AWS resources. The company swiftly changed credentials and enlisted forensic experts to assess the breach, assuring that no client funds or credentials were affected. Despite the breach, Angel One reported growth in its client base, which reached 3.01 crore rupees, and increased market share in January 2025. Do let us know your opinions in the comment section below. Having said this is Neha signing off.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.